So starting with the chapter of time value of money. In this very simple chapter, we are going to learn very simple 5 formulas. These 5 formulas are divided something like this. The future value formula and present value formula. There are 2 present, that is future value formula, and 3 present value formula. The future value formula is divided further as future value interest factor, future value interest factor annuity. The present value formulas are divided into 3 parts. In that, we have a formula called PVIF, PVIFA, and so one is the perpetuity formula. Bas khatam ho gaya. These are the 5 formulas that we are going to understand, that we are going to learn over here. Nothing more than that. We are going to have a discussion about each of the formula as and when the chapter progresses. But these are like the very simple and the basic formulas to make some calculations with respect to like compounding, with respect to the discounting that we are going to discuss. So let us start with this very basic question. Mr. X is investing rupees 100 today for 3 years. Dear students, the term today stands for year 0. The term today stands for year 0. With Messrs. Reliance Company, calculate maturity amount of deposit. Rate of interest or cost of capital is 10%. That is a question. I want you to calculate answer of the question on your own. Let us have understanding, let's say how to calculate the answer. Dear students, over here the question says that say only 100 rupees is invested for 3 years and calculate the maturity amount of deposit at the end of the 3rd year. We can do answer like this. Method number 1. We understand that say first year, second year, 3rd year. 100 rupees into 10%. In the first year you get interest of rupees 10. Then this 10 rupees of the interest will be added to 100 to compute interest for the next year. So it is 110 into 10%. That comes to 11. Again this 11 rupees is added to 110. That comes to 121 into 10%. So this is 12.8. So the total amount of the interest is 33.8 plus 100. So maturity amount of deposit is 133.8. Dear students, always we make an assumption in absence of an information that the interest rate is on annually compounded basis, and accordingly we are required to compute maturity amount of deposit. So this is the very simple first method by which you can do the answer. Over here the time period is very short. If at all the time period is very long, then going with this method is of course not possible. And in that case we require to apply a formula. So we have method number 2. In method number 2 we'll compute the answer like this. Maturity amount is equal to investment into future value interest factor at I rate of interest for n number of years. What is the investment? Investment is 100 into 1 plus I raised to n. 100 into 1.10 raised to 3. Now what does this future value interest factor is indicating? It is indicating that if 1 rupee is invested today, at the rate of 10 percentage for a time period of 3 years, what is the maturity amount of deposit at the end of the third year? That is the way we are required to make the calculation of answer. So 1.1023, 1.331 means every 1 rupee invested today will become 1.331 at the end of the third year into 100. So maturity amount of deposit is rupees 133.10. This is the amount that say you are going to receive year 3 end. That is what we understand. Write down answer by both the methods or at least by second method. I am reading the note. We are required to calculate maturity amount of deposit for investment. Information given. For calculating maturity amount of deposit, future value formula is supposed to be applied. As investment is made only for once, FViF future value interest factor formula will have to be applied for calculating maturity amount of deposit. FViF is indicating that if 1 rupee is invested at I rate of interest or cost of capital, then what will be the maturity amount of deposit at the end of nth year? That is third year in the example that we did. Investment is made for 3 years. It means that investment is maturing at the end of third year. Investment is made today, so it will be considered as year 0. Any amount received or paid today is considered as year 0 cash flow. In absence of any contrary information, it is assumed that rate of interest or cost of capital is considered on annually compounded basis. That is an assumption which is made. That's the rate of interest is assumed to be on annually compounded basis.